All right, let's talk more about the markets and what we've been watching this morning. As you've been seeing, the futures right now are indicated up by about 384 points. They've been all over the map. We did watch the futures limit up at one point. We also saw them, and not too long ago, get back along the flat line. Obviously, a lot of people watching and wondering what's going to be happening. Got a couple of market experts to bring in right now. Darrell Cronk is the president of the Wells Fargo Investment Institute. Tom Kennedy is with fixed income over at JPMorgan Private Bank. And gentlemen, welcome to both of you. Darrell, why don't we start off just saying, what are you thinking after the Dow turned in its worst performance since 1987 yesterday?
Yeah, good morning, Becky, and happy St. Patrick's Day to all of you. So I would say yesterday was particularly disorderly. We saw it across both the equity markets and the fixed income markets. As you know, the VIX closed at an all-time high of 83. History tells us over and over again you're not going to find a bottom when you're trading at that level of implied volatility. So I think we probably have some more testing to do, and again, that would be consistent with history. There's key support on the S&P around 2350, which were the December 2018 lows. We'll probably have to come close to testing those once or twice. If that fails, you're probably looking somewhere around 2100. So it's, this is a story of where the biological cure, which you guys are experiencing this morning, the social distancing, is becoming the economic disease in many cases, just because it's shutting down the whole economy, and we're really not we're not separating winners and losers at this point. The markets are just looking for liquidity, stimulus, and solvency at this point.
Hey, if history tells us that the VIX, when it's at its highest levels, that's not when we see a market bottom. Where is the VIX generally when we see a market bottom?
The highest it's ever bottomed has been at 77, so we're not too far off. But you typically want to see the VIX fall back down, or implied volatility fall back down into the 50s or 60s, which suggests some kind of stabilization, some kind of durable low that you're forming. You just can't do it when you've got these kind of volatility extremes. A VIX of 80 plus implies 5 to 7% daily moves every day in the indices.
Tom, we were looking at the yield on the 10-year Treasury earlier, sitting at 0.8%. That sounds like it's a more stable level, but that certainly doesn't tell us what's happening under the surface. There have been so many questions about what's happening in the credit markets. What do you see in the fixed income markets right now?
Good morning, guys. Fixed income markets, just like Darrell said, is having some very challenging market functioning issues. If I take the big step back and try to look at what policymakers are dealing with right now, they're fighting battles on two fronts. The market functioning is battle number one, and battle number two is the economic consequence and fallout of this virus, which in the segment prior you guys were talking to. The market functioning issues is not really getting enough airtime at this point. Inability to execute trades in a transparent way is happening right now. It's pronounced in credit markets and subordinated debt. And for policymakers, this presents the challenge of an inability to adjust markets to the economic situation that they're in. When you're looking at the front end of credit markets, the Fed has cut rates 150 basis points in the last 3 weeks, but LIBOR has not followed lower. So that's creating problems with their ability to transmit their decisions. The really upside discussion point here is that the Fed has stepped in, and they are recognizing this, and their package that they announced on Sunday is unprecedented. The tidbits I think that are resonating with our clients is the pace of bond purchases, buying Treasury bonds at $40 billion a day relative to QE3, where they were doing $45 billion a month, is incredible. And then cutting the reserve requirement and lowering the discount window rate introduces a lot of liquefied collateral into the system. So central banks or really the Fed is fighting that war for us too, but we do need fiscal to step up on the economic deterioration side.
Tom, would you advise any clients to actually buy corporate bonds at this point?
Yes, I would. I think statistically, it's a time to leg into high yield. Of course, I want to do it in a very controlled manner, and double B credit looks like an interesting play here. What's in the price is the way I think we need to think about this market. When you have high yield credit spreads trading at 900 basis points over, you're getting compensated for a default market like we saw in the financial crisis. So you're getting compensated for the risk that you're taking there. Like, that doesn't mean spreads can't go wider. I think it's quite logical that they will, given the volatility we've seen in markets. But if you're a long-run investor, that's a place where you can get low double-digit returns.